What if you can't pay your mortgage? Scott Theriault is here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Scott Theriault, Manager of Consumer Insolvency here at Hoyes Michaelis. Welcome back. And I got to tell everyone, this is the Cursed Podcast. You made the trip to Kitchener a few weeks ago. We recorded an absolute banger of a podcast, and then we had a massive technical failure, and all was lost. And I won't go into the details because nobody cares.
You think it has something to do with Halloween?
I think so. Yes, because you're right. We recorded it
because we recorded it before and then
Halloween.
Out after that it was
right. And yes, you're right. So it might have been. So here we are. I don't know what month it is. November, December. Maybe we're in the spring. Who knows? So. And then today, of course, we figured, okay, well, let's boot up the Zoom. We know how to do that. And of course, your Zoom wasn't working. Mine wasn't working. We had to redo drivers and everything. And you are currently suffering from a cold. And
so beware all those watching this podcast.
That's right.
This is your warning.
You never know.
Just want to skip this one.
Yeah, you never know what you're going to get. So
just read the text.
We appreciate that you have decided not to take any cold medication so that you will be awake for the next 30 minutes. So that's fantastic. So, and the reason we wanted to get this podcast done is because this is a big issue. Now, you do a lot of work in Toronto, obviously, biggest city in the country, and there are an increasing number of people who are having mortgage difficulties. Now, my sense of it is that we're not at catastrophic levels here. When you look at the stats from the economist guys, it says that the mortgages that are behind, okay, they've increased, but it's a fairly small number. Like it's not 1% or anything like that. It's a pretty small number. So what I keep telling people is, I think this will be an increasing problem in 2025. Mm-hmm. And the reason for that is interest rates have been, obviously interest rates went way up. They've kind of eased off since. But if you are renewing your mortgage today and the rate was half as much when you got it, then it's a problem. And so that's why I think the problem, we are in the second or third inning of this. We are not at the end of it yet. Do you agree, or do you think the problem is worse than what I am stating?
No, I think it's at the early stages of this. So if people are having trouble paying their mortgages, we're just starting to see it, right? We've been speaking to homeowners now for a year, whereas we hadn't spoken to homeowners for a long time before that. But just because you're a homeowner, most of the homeowners we've been speaking to in the last 12 months are current on their mortgage. They're just not current on their credit card debts. Mm-hmm. So that's why they're calling us. They're not calling us about their mortgage. They're calling us because, okay, well, I'm starting to miss payments on my credit cards, or maybe even to the point where I'm also missing payments on my car loan, but not my mortgage. And so I think what's coming soon or next is people saying, yeah, I'm going to have trouble paying my mortgage. Because as you know, changes in interest rates they figure 18 months to actually have an impact in the financial world. And so that's about right, because at the end of 22, they stopped raising. And so now we're into 24. And so there's been a few months since the 18-month mark of that. And people will always pay their mortgage regardless of missing anything else. So really it makes sense that we're only just starting to hear about missed mortgage payments now because, okay, they'll miss other stuff first. So yes, we're in the early stages of this. So I believe you're right. 2025 and 6, I think we'll be seeing this much more. So it makes a lot of sense to talk about it now.
Yeah, I totally agree. And when people come in to see us, in almost all cases, they're up to date with their mortgage or their rent because that comes out of your account first day of the month. You have to pay it or else you don't have a place to live. So it's everything else that slips. If someone actually gets to the point where they're behind on their rent, then it is, or their mortgage, it's a very serious catastrophic problem.
Yeah, it means they've missed all the other ones too, probably.
Right. You're in really bad shape.
You're pretty much missing everything at that point.
So are there any early warning signs? And I agree with you. We both are on the same page that we are early in this discussion. This will be a big item in 2025 and 2026. Are there any early indicators that you are going to be struggling with mortgage payments, or is it really as simple as what we just said? Well, your payment doubled. That's probably why you're going to struggle with it.
I think the biggest indicators are starting to miss credit card payments because of the number of people that you and I speak to and everybody in our firm speaks to who are amazingly still current on their credit card payments. Right, their score is 800. They've never missed a credit card payment somehow, even though they're paying like $1,200 a month in minimum payments on credit cards or more. So I think if you're actually starting to miss credit card payments, you could probably take a portion of that, pool of people and say, okay, 6 or 12 months from now, these people are likely to be missing rent, mortgage, whatever. And we're specifically talking about mortgage here because, as you know, you can miss a bunch of rent payments and still keep your place because of the way the landlord-tenant board works and all that stuff. That's a separate issue. That's another podcast entirely, of course. But missing your mortgage payments is much more serious because the banks don't like that. And you will have a lot less leeway than if you're missing, 6 to 12 months of rent payments.
Yeah, it might take your landlord a year to be able to get you evicted, get in front of the landlord-tenant. It might take longer. It might take 18 months. Whereas the mortgage company, well, they're on you right away.
Yeah, you're not getting 18 months.
No, you're not getting 18 months. I mean, it's not like they're going to kick you out for being a day late, but you get to the 3-month mark and a bunch of stuff starts to happen, and 6 months it gets really serious. So, and I think the point you raise is a very interesting one that people would not understand is when people come in to see us. And again, we're an insolvency firm, Hoyes, Michaelis and Associates. We do consumer proposals and bankruptcies. When people come in to see us, there's a significant number of them who have very good credit scores.
Yeah,
it's not unusual to see someone
nothing
with
for
800.
me to see 800 or over, or certainly 700s.
Yeah, it's not like they're all at 450. It's I've got all this debt. I'm barely keeping up with the payments, so my credit score is really good. But boom. We're getting close to the breaking point. So what you're saying is a really early indicator is you're starting to miss credit card payments, because once you start missing credit card payments, well then everything else starts to fall, and that's when you start getting behind. So and I don't think we have to go through why this happens. I think we kind of know what happens. People lose their job, they get sick, unexpected expenses.
It's largely event driven.
Event driven, right. And again, the perception out there is, well, people are just bad with money and that's why they get into trouble. Well, yeah, there's certainly some of that. But in most cases, you're right. It's event driven. Something happened. If I lose my job and it takes me 6 months to find another job, how many people have 6 months worth of money just sitting there?
And then here's the other thing about that. And this is, we see a lot of this is you're not, once you get that job, you're not making nearly as much as before.
Yeah, because
that's a huge problem in our industry, right? Where you have a lucrative job for years, then you get, what's the word? Redundancy.
Downsized, yes.
Yeah. And it takes you 6 to 12 months to find a job. And then when you find one, you're making 60% of the income you made before. And so now you've got a perpetual problem.
Yep.
Right. Not just a temporary event, but you've got an ongoing issue.
Yeah. Most people, if you're working at a job making $50,000 a year, but you're worth 150, well, you're probably moving. So you don't quit a job when you're overpaid. Yeah. And unfortunately, you're right. That's often what happens, particularly in an industry that's going through some kind of contraction. So, okay. So the title of this show is What If You Can't Pay Your Mortgage? We got to get to that because I'm afraid all our cameras are going to blow up given how cursed we are here today. So what are, if you think you can't pay your mortgage, let's say I got a payment coming up in 2 weeks and I'm pretty sure I'm going to miss it.
Yeah.
What is the first step, the number one thing that you as a borrower should be doing?
Well, first of all, you should know certain things, and then we'll talk about what you do. So you should know that you're not going to necessarily lose your home, right? Okay, right off the bat. But swift action of some kind is required on your part to get the thing from going out of your control. Okay, that's key, is your control, right? So if you don't want this to become the bank's issue, you want it to be your issue where you go and you take active steps. And by that, I mean contact your bank. So the earlier, the better in this case. So in other words, be open, be proactive with the bank and say, look, I think I'm going to miss a mortgage payment here. Okay. And there's a bunch of reasons for that, but you don't want this to go so far that you start to lose control of it, because then you might have no recourse other than losing your place.
And okay, so in my example, 2 weeks from now, I know that I'm not going to be able to make my mortgage payment. So your suggestion is I get on the phone and talk to a human being and I say, look, 2 weeks from now, I'm not going to be able to make my mortgage payment. What are you asking the bank? Are you saying, hey, can you defer that payment? Is that the opening salvo?
Well, I think you just tell them you're not going to make it. And then they have a whole flow chart of, here's what we do next, right? So you want to get them talking, because the banks do have options for this, okay? And they don't want to do this, but they also don't want to own your home. So banks don't want to have houses on their books, however temporarily. It's just not what they want on their balance sheets. And so it is in the bank's interest to keep you as a mortgage borrower and to maintain your mortgage payments over a long period of time, because that's how they make the bulk of their money. You know, the big chartered banks in Canada make most of their money from mortgages. And so you're fessing up to them and saying, look, okay, I can't make my next payment. So the bank doesn't want to repossess your home, period. Okay. So they're going to implement something with you to get you through this hopefully temporary period. So they have a bit of motivation to help you remedy this problem. But they only have so much latitude. Like, they can't work miracles here, because number one is, depending on whatever your original agreement in the mortgage says, and most of it's boilerplate, but when it comes to, options for what if I can't pay my mortgage, the bank only has so much it can do. And people in banks, as you know, can only think so much. They don't have the kind of latitude that people in other industries might have. So tell them early, see what they say, start from there. Yeah,
and you're right. If a bank has 1 million outstanding mortgages, they can't be making a separate specific deal for every single person.
Yeah.
Here's the playbook. Now, in virtually every mortgage, there is the ability to defer a payment. That's not an unusual thing. So if you think your situation is temporary, look, I lost my job, but the good news is I start a new job in 2 weeks. So in a month, I'll be able to catch up. Then that's going to be pretty simple. The bank says, fine, we'll move your payment to the end. We'll defer it. You're going to end up paying some extra interest. Maybe we'll hit you with a service charge or something, but then you're good.
So it's a temporary arrangement.
Temporary arrangement.
So ideally, you have what you just described, is where I have a blip. I lost my job, but I already know, like, a lot of people are in the kind of industries where, okay, they can just get the same job at a different place. Great. And they're already on it, or they know people or whatever. So I know this is going to be like a 60 or 90-day period of a problem. The bigger problem comes into where you don't have those prospects.
Okay, so let's talk about that then.
What are you going to do, right? So in other words, a mortgage deferral program won't work if your problem is catastrophic, right?
Yeah, so mortgage deferral works if I need a month. Maybe if I need 2 months, maybe I can push it to 3 months, but
maybe 3, yeah.
But a month or two is probably the thing. So, okay, so I got some other ideas. You tell me what you think of this. Okay. Idea number one is a mortgage deferral. We already talked about that. Yep. Idea number two would be, well, can I refinance or modify my loan? Mm-hmm. And I guess that means going to the bank and saying, okay, bank, look, I've got 2 years left on the amortization, or 2 years left on the term of my mortgage. Yep. So I tell you what, can you give me a new mortgage for the same amount, but the payments don't start for 3 months? Mm-hmm. That's going to be a stretch for the bank to do.
Yeah, like that's more of so you said in your case, your example was 2 years until your renewal. So if your renewal is coming up within 6 months, then the bank might okay, you're going to be in our office anyway soon, right? And you're describing to me a 2 month or 3 month blip here. And so we're halfway to the renewal or whatever. If it's 2 years, you got a big problem, because I don't think the bank can do a lot about that, right? That's not the kind of latitude they have. They can't say, well, defer 18 payments. Mm-hmm. Like that's not a thing.
That's not a thing.
When we talk about deferring mortgage payments, we're talking about 2 or 3. And we're talking about them adding all that interest on to the back end of the mortgage again, and you're going to pay penalties maybe, and you might maybe even take a ding on your credit because you missed a mortgage payment, an R2 or an M2, I should say, or whatever. But if it's longer term than that and you can't get to your renewal for a while, you have a much bigger problem then, because now, well, do you even qualify?
Yeah, that becomes.
If you just lost your job, and we just talked about a catastrophic event versus, okay, I lost my job in IT, but I'm getting one 30 days because everybody needs IT guys. Okay, great. But if you lost your long-term job in, say, manufacturing.
Yeah, the plant closed down.
Yeah, and there ain't much hiring going on with manufacturing right now, to say the least. Now you've got a big problem, because the bank can't handle that as a deferral. So if you switch to, as you said, well, I'll just refinance. Well, yeah, but you got to qualify.
Well,
and I guess half your household income just went away.
You got a problem. Well, I guess a part of this will depend on what your equity situation is. So if I got a house that's worth $1 million and my mortgage is $200,000, okay, then perhaps I can go to another lender or maybe even my own lender and say, look, can you give me a HELOC for a home equity line of credit for 50 grand or 100 grand, and I'll use that to make the mortgage payments for the next year, and everything will be fine. I'm still got tons of equity. So
even if your own lender won't extend you the equity lending, somebody else might. Now, here's the thing. I don't want people to get excited about this because expectations are a great deal of what we try and manage in our business. And I think it's no different in this. If you have your scenario of $1 million value and only 200,000 mortgage, okay, you got a nice juicy $800,000 in equity. But you go to somebody else in this particular market that we're in, where banks are doing a lot of loan loss provisions and things aren't great. You're not going to get a great rate maybe, but somebody will probably lend you, probably not the 800,000, Doug, but maybe 100,000 or whatever. And you can use a bunch of that to pay your mortgage for a year or two if you have to, right?
And that's kind of the key then. So, okay, so if you've got lots of equity, then you've got lots of options. If you don't, you don't. So an equity
But it may not be a great rate.
Yeah,
right? Don't want people thinking you're going to go get that 3% rate from somebody who's either a secondary or private lender. It's not going to happen. Okay, so you have to remember that you're in a lot of trouble. When you're in a lot of trouble, you don't get to steer things, right?
Yeah, you're not driving the boat here, which I guess is why a lot of people, when things are going good, so in my example, I got $1 million house, I've only got a couple $100,000 mortgage, that's the time to get a HELOC. So I don't have to draw on it, but I've got the ability to borrow another 100,000 or whatever it is, so that if I have the catastrophe, no problem, the cash is already available to me.
Kind of an equity insurance policy.
Yeah, it's the new version of an emergency fund. I've got access to credit. And now, of course, a home equity line of credit or any line of credit, the bank can just take it away whenever they want. So you got to be a little bit careful about that. So, but that, again, we're trying to be proactive. Now, we're talking about what if you can't pay your mortgage? I guess it's kind of late to be, like you said, you're not driving the bus anymore. So the conversation you and I have with a lot of people, and this never goes well, nobody ever likes to hear this, but we say, hey, you know what you could do is you could sell your house because you got $1 million house. You've only got 200,000 owing on a mortgage, or even if you've got 800,000 on the owing on the mortgage, you can sell the house, pay off the mortgage, pay off all your debts, and you still have some cash in your pocket. But when we say that to people, what's the most common response you get from people?
Well, there's 4 seconds of silence.
Or half a minute.
And then possibly a short laugh. Like it's never happened. I've been doing this 15 years. You've been doing this longer than I. And I've never seen somebody actually go and sell their house and fix their problem and then rent for a while or whatever.
And like, why not?
I don't know what the economy is going to have to take for people to do that. Well, because it's a Canadian mindset, right? Like selling your house is losing. It is what's in people's minds, I think. And so it shows that you failed. Because you have to actually sell your house. You have to move. All your neighbors see you move. All the people that your kids go to school with know now you're gone, right? Like it's not something you can keep really quiet. And so therefore, it is a clear, notion of failure. And so I understand that. But it is also I think it can be a very good solution because if you get out of a rough market, you might end up getting back into it if you have the equity you described where, okay, I got out, I paid my debts, I'm renting somewhere, and I have $350,000 in the bank.
Yeah, life is pretty easy then.
Well, you've got more than a down payment, right? And so on paper, you're probably in good shape because you didn't lose your house, you sold it. So you're not an R8 or an M8 because the bank took your house and sold it either in foreclosure or power of sale. So really, your credit's nice because you got no debt because you just paid it off. You're renting, okay, fine. So I rented for a year and I made all my rent payments great. I have a down payment now that's really juicy, which means my mortgage would be good because I'm putting a lot more down. And you're probably going to have a lot more options in the housing market because you just got out of a bad housing market. So people
presumably
don't really want to hear that solution, but really it's a good one.
They never do. And I think you're right. This is a psychological thing as opposed to a financial thing. And I
totally is.
I get it. I've been living in the house for 10 years. My kids have all their friends here. I got to move and that's going to look bad. And the other thing is people think of their house as something they own. And so I'm losing something I own. Well, you don't really own it. The bank owns it, but okay, I get that. And so I have people,
we don't want to sound like Dave Ramsey here.
Yeah, that's right.
Sell your house, idiot. Move on. Next. And but that's really, it is an option that people don't consider enough.
Yeah. And so my advice is crunch the numbers. So, okay, I get it. If you sell the house, you're not living in the house anymore. And I understand that your mortgage payment is $3,000 a month, but to rent a house is going to be $4,000 a month because you got 3 kids, a dog, a cat, and a goldfish. So it's going to cost me more. Well, not necessarily, because it's not just the mortgage. Obviously, you got the property taxes, the maintenance, the roof leaks. You got to fix it, the whole bit. So number one, crunch the numbers as to what it really costs to live in your house versus what it really costs to rent. Yep. And also go out and find a place to rent. Like, let's not be dealing with this as some nebulous thing. Yep. What can you actually get? And I get it. In some cases, maybe it's impossible, but you want to have at least had that, gone through that thought process. And you're right. If you sell the house, pay off all your debts, you rent for a while, if the housing market goes way up, and that's what everyone's worried about, the housing market's going to go way up, I'll never get back into the market. Okay, that's a risk. I totally agree. If the housing market eases off, or maybe you're able to move farther out of the city so housing costs are cheaper or whatever, then maybe you can get back in. Yeah. The big issue.
The other thing too, just on that note, Doug, before I forget, you're also a lot more flexible in a lot of ways as a renter. So if you do this and go rent, you're more nimble in order to get back into a market if it's a good one to get into. Right? Because, you don't have to sell your house and all that stuff. You can just tell your landlord, okay, I got 30 days. I paid first and last. I'm out of here. Right? So you can actually capitalize or take advantage of opportunities out there for houses. Right? And a lot of people have, that's one of the big challenges when you go to buy a house, especially in a hot market. There's all these conditions you waive, but you're also in competition with 10 or 15 people. And if their timeline suits the seller better, then they're probably getting the place. If you're a renter, you can pretty much do any time. That might be a huge advantage for you.
Well, and if there's a great job that opens up in London, Ontario, or Alberta or somewhere else, if I'm a renter, like you say,
30 days.
Yeah, I give notice, and I mean, maybe I've got a 1-year lease or something, but whatever.
And I have seen that with clients where, they're already existing clients of ours, and then they phone us and they say, you know what, I can go work in Calgary next month. Is that okay? I'm in a proposal. So, they're able to get up and go because they're renters.
Yep.
Right. Whereas if you're a homeowner, oh, geez, I got all these things to think about. And you don't want to miss out on a great, potentially lifelong job opportunity because you couldn't go, right?
Yeah. Well, and in my book, Straight Talk on Your Money, which of course everyone reads every month just as a refresher, I talk about a house being an anchor, which is a good thing. If, my family is there, we've put down roots in the community.
But anchors work two ways.
But anchors work two ways. I cannot move now because of the house. So I guess our point is, give serious consideration to selling your house because there's a bunch of upsides. Yes, I know immigration is going to stay high, house prices are going to go up forever, and you're going to be out of the market. But you don't want to get to the point where you're missing payments and get behind and lose the house anyways, because that's even worse. So, okay, I got 2 more things to cover. One of them being, okay, if I start missing payments, then what happens? So what's
the timeline? I think this is important. I was just going to jump in and say that anyway. So, okay. I think from the technical standpoint, people should know how does this work. So if you miss one payment, 30 days. 30 days is kind of the standard credit reporting system trigger, right? For anything, whether it's credit cards, lines of credit, car loans, mortgages. So if you miss one payment, your bank will likely contact you as a general courtesy before they do anything anyways, right? Because again, we're back to they don't want your house. If it's just a matter of something happened or maybe I don't know, something happened with your bank account. It could be anything, right? But you'd rather be telling them you're going to miss still than have them contact you. So if you did miss a 30-day payment, the bank will typically then give you a 15-day grace period, after which lenders are allowed to take legal action to initiate sales procedures, whether that's foreclosure or power of sale. But the 15-day period is also rarely used by the banks because, again, we're back to seizing and selling your house is costly for the banks. It's a pain. It's time consuming. They don't want your house or thousands of them, by the way. Because if we're looking into 25 and 26 here, where this is starting to be a real thing, the banks also calculate how much of this is happening. Like if it's just Doug Hoy's missing his mortgage payment, that's one thing. If it's Doug Hoy's and 10,000 other guys, maybe the bank's more amenable because they don't want to lose 10. They don't want to have 10,000 houses instead of one. So it part of it depends on what is going on in the banks and in the broader economy, because realizing on an asset like a house or a condo is a business decision by the lender, right? It's better for them to work with you over a long period, maintain you as a mortgage borrower, make interest and all that, instead of cutting their losses and selling your house.
Well, it's also
but you
bad
still have
PR.
to be mindful.
It's bad PR. Like the bank doesn't want people to know, oh, well, it's Bank ABC kicked that guy out of his house. Okay, he was behind on his payments and everything, but that's something they would. Yeah,
because all these economists are measuring this stuff every month, right? Business journalists and everybody else. And you're right. So if suddenly, foreclosures or powers of sale are blossoming, that's not good for the economy in general, but it's certainly not good for the banks, right?
So, okay, if I'm 30 days behind, they'll be able to work something out, maybe 45 days, whatever. But if I've now missed multiple mortgage payments, then what happens?
60 to 90 is bad. I think 30, you're still okay. The bank will still work with you. Technically, they could do something, but they probably won't, but you need to be talking to them. Or your mortgage broker or somebody, right? You should be talking to somebody. 60 days is getting bad, really bad. 90 days is probably your toast. So then selling as a last resort for the bank. Well, so now maybe we should talk about foreclosure and power of sale, just so that people understand terminology. Like it does the same thing. So in a sense, it doesn't matter. And I heard Ted say that before, and he's right. Like, who cares if it's power of sale or foreclosure from the point of view of the person losing the house?
At the end of the time, you don't have your house.
Yeah, it doesn't matter. But really, okay, you should understand, though, that those terms are used interchangeably, even though it's different procedures. So different provinces tend to use one or the other, power of sale or foreclosure. Really, the only difference is in foreclosure, it's a big, messy court thing where, it's more expensive for the lender to initiate, but it's a court proceeding where title transfers to them and all this stuff. It really doesn't matter, again, if you're the one losing your house. Power of sale is a quicker, more efficient non-court version of taking your house and selling it, basically. So all you have to worry about, though, if you hear foreclosure or power of sale, it ends up meaning the same thing if you're the person losing your house.
Yep. Yeah. And so you do not want it to get to that stage if at all possible.
No, and especially foreclosure in a sense, too, because it's a court proceeding. So if a lender is initiating in a province where they do foreclosure, if your bank is sending you a notice of sale that the foreclosure is starting, you're probably screwed, because they're not going to back up all that. They paid their lawyer to do all this stuff. Power of sale, maybe they could still at the last minute do a Hail Mary and, make 2 mortgage payments or something, and we'll just call it a bad day. But really, those terms are interchangeable from a, the person in trouble's standpoint.
Yeah, and the big risk here, obviously losing your house, that's bad. But if your house is worth, if the mortgage is $800,000 and after all is said and done, the bank is only able to recover $700,000 because the price wasn't as high, they ended up paying all these fees and costs and legal fees and whatnot, they're coming after you for that $100,000 shortfall. Yep. That's the final indignity. I've lost my home and now they're still pursuing.
Yeah, unless you're in Alberta, there's full recourse in this country. Nobody does jingle mail here and says, okay, well, sorry for the $200,000 shortfall. I can't pay it. They are going to come after you in court for that shortfall.
Yeah, this is not the United States. And yes, I understand there's CMHC insurance and the bank gets that, and eventually maybe it's CMHC coming after you, not the bank. But that's
all that does is shift who's coming after you.
Somebody is still coming after you.
It's not the bank, it's CMHC, but they will definitely come after you.
So my final question then is, if I've had all this mortgage trouble and maybe I've lost my house as a result of it, is it possible to ever rebuild? Or am I completely toast for the rest of my life?
No. So yes, we talk about rebuilding credit with people every day. So in fact, I've already talked to 2 people this morning about it. So what happens technically when you lose your house is that you get an M8 rating on the transaction history portion of your credit score. What the heck does that mean, Scott? So
what does that mean?
Your magical 3-digit credit score has 5 inputs. Now, nobody knows the formula because they don't want you to, but we know the inputs more or less. So the biggest input is that one, transaction history, which is basically how often you make your payments. And that's 35% of your score, more or less. So it's the biggest weighted input of all. And so it's a scale of 1 to 9. 1 is you make your payment every month. Great. You're perfect credit from a transaction history or payments point. A 9 is either a written off debt or a bankruptcy, or you're just long gone. That's the worst. So the scale gets worse as the number gets higher, of course. 8 is a repossession of some kind. Some kind of asset was repossessed. So you didn't pay for your car. They took your car. They sold it. Maybe they sued you for the shortfall, whatever, but you get an 8. In a mortgage situation, it would be an M8, mortgage 8. So if you didn't make your mortgage payments, the house was sold, doesn't matter whether it's foreclosure, power of sale from your standpoint, you would then, the lender would give you an M8 rating. That's bad. Because not only is it an 8 out of 9, but it's an M8. And I think a lot of people looking at that would go, geez, it was so bad the guy missed his mortgage payment, not just an R8 revolving where he missed a credit card, not an R8, that wouldn't be in that case, a car loan, let's say. So it's bad, but you can rebuild because it only lasts for 6 or 7 years on your credit report, right? So these things all go away eventually in terms of like the debt wouldn't go away if there was a shortfall you didn't pay, but the actual rating would drop off after 6-7 years. Now, the only way to rebuild credit other than having credit history, which you can't do much about, is largely to manage how much you owe versus how much you have available to you, but also to make payments of some kind, because again, it's the biggest input. So you better get some kind of credit card or something where you're paying something back every month that is also tied to the credit rating bureau, right? To Equifax or TransUnion. So, because it's no good paying something back, for 5 years or something if you didn't get credit for doing it. So yes, you can rebuild. It takes time. It requires a series of R1s over a long period of time to offset the 8 that you got because your score is being damaged by the 8 of the repossession. So the more R1s you get or 1s you get by a credit card payment or something else or car payments or whatever, you're going to need a lot of those to help offset that. But yes, it's doable.
Replace the bad with the good. So,
yeah.
And I think what will happen in 2025 and 2026 is people who end up in a situation where, well, I got $100,000 or $200,000 shortfall. And I suspect it will be more pre-construction buyers as opposed to people who own a house
condos.
Condos, yeah. But assuming that happens, like, well, there's no way I can ever pay back a couple $100,000. So they come in, they see us, they file a consumer proposal or a bankruptcy or whatever. Obviously, that puts a note on their credit report. But then once they've done that process, the debt is officially gone. And you're right. From there, you start rebuilding.
Yeah.
Small credit card and gradually build.
Yeah, the difference with doing the insolvency proceeding versus what I described a few minutes ago, which is just trying to rebuild over time, is the debt is gone.
Mm-hmm.
So, the 7 years have passed or 6 or whatever, but you're debt free versus if you're doing it on your own, those shortfalls are still there because something dropping off your credit report doesn't mean the debt's gone. Okay, now maybe the 2 years has passed and they can't sue you anymore in the Executions Act, but the debt's still there. So the difference is you're engaging in a global debt solution, I guess, by doing an insolvency proceeding because it also puts the shortfall in as an unsecured debt as well.
Yeah, and if you've got a $200,000 shortfall, they're suing you. So there will be a judgment.
Problem.
Yeah, there'll be a judgment against you. It's not going to be subject to the 2-year limitations period.
Yeah,
it's not
even I'm impressed with $200,000 in debt.
Yeah, like that's
a lot.
Well, and it's more than what people can repay. So
yeah.
So okay, well I think the answer then is, what if you can't pay your mortgage? Well, number one, you want to reach out very quickly to your lender and say, hey, look, can we work something out? If it's temporary, they probably can. If it's not temporary, do you have lots of equity? Can you refinance? If not, then you got to consider selling your house. Like that's we hate to say it, but sometimes that's the solution. And if you do get into a situation where they have taken your house, you do have a huge shortfall, well, maybe an insolvency proceeding is necessary, consumer proposal or bankruptcy to eliminate the debt. And then you go into hardcore credit rebuilding, which, as you say, is something we talk with our clients about pretty much every single day. So
yeah, you have time, but not a lot.
Yep. So you got to be proactive in all of this. That's, I think, the main takeaway. So
the bank doesn't want to sell your house, but they will.
Yep. Because they got a job to do. They got to protect their shareholders as well. So, well, excellent. There you go. I think we got through the entire podcast. Your voice held out. I think the cameras are still running. So hopefully people get to see this. So for anyone watching, if you've got questions that you'd like to ask Scott Theriault or me, you can go to hoyes.com, HOYES.com, type in Theriault, Terrio, I don't know how you spell your name, Terrio.
Sounds right.
And just click
Close
on
enough.
the link for the Toronto office, and you can send them a message. If you are watching this on YouTube, then click the like and subscribe, because the algorithms have been getting kind of wonky recently and people have been unsubscribed somehow. So you want to make sure you're clicking that button. We are on all the different socials as well, so you can follow us there. I will put links into the show notes about what we've talked about, including a link to our credit rebuilding course, which goes through a bunch of the stuff that Scott mentioned. So that's a good resource for people as well. Otherwise, we will be back next week. One other point I'll make is that we do have a newsletter that has a bunch of tips on managing your mortgages, finances, and if you send, and it goes directly to your inbox. So please check that out as well. I'll put a link to that.
Our clients love those.
Yeah.
I get comments on those all
the time. And because it's not a newsletter about bankruptcy. We're not talking about bankruptcy. We're talking about, hey, here's
and if it's a subject you're not interested in, you open the email and you go, nope, that's good. And then if it is, great, right? So it's very selective.
Yeah, and the open rate on that email is huge. It's like most emails, it's like a 2%. Ours is like 40 or something. It's a massive open rate. So again, feel free to subscribe to that and subscribe to this podcast, as I said, on YouTube and all podcasting platforms. Scott, thanks very much for being here today.
Thank you, Doug.
We will talk again, and in fact, we will be back next week with another edition of Debt Free in 30. So until next week, thanks for listening and watching. I'm Doug Hoyes. That was Debt Free in 30.